So this is a strategy that I developed a few months ago, and I've done extensive testing on this strategy. I will tell you guys, though, everything else in my course, if applied, is a lot better. It's a lot better, but guess what? Not everybody has the time in the world to sit there from daylight to dark, wait for these structure changes. You could be driving. Hopefully you're not trading and driving. Let's not condone that. You could be, camping. You could be at a friend's house, at a pool party. I don't know. Maybe you're on vacation. You don't have all the time in the world to do anything besides look at your phone to open a quick trade, right? But you want to make sure you have some extra confidence in that trade. Well, this is why I developed this strategy in particular due to lack of time. Like in the summer, I enjoy myself. I'm not going to sit there all day and open my trades. These are the 2 months, July and August, where I spend the most money. I spend a lot of my trading earnings. And I'll tell you guys, I still obviously trade during those 2 months of the year. But at the same time, I'm busy. So there's many instances where I've taken trades due to this strategy where, I didn't have the availability to look at a laptop or my desktop computer, and I had to take it off my phone. And it's quite hard sometimes to see market structure on an iPhone despite the size of your screen, realistically, especially if you're doing things like fishing or camping or hiking. So this is where this comes into play. It's called the Bollinger Band strategy. Now, to my knowledge, it's not something that I've ever seen out there before. I'm pretty sure I invented this. I obviously did not come up with the indicator. I generally do not trade with indicators, but this is an OG indicator. And it's not that it doesn't involve smart money concepts, because in theory it does. It still involves range deviations, except we're not really waiting for market structure to shift. We're waiting for confluence using the Bollinger Band itself. Now, maybe you want to use this and you are trading on a computer and you're like, you know what, I'm going to use this on top of market structure changing, on top of everything else, just to have that extra confidence boost. By all means, please do so, because this works incredibly well, especially if done on the 10-minute time frame. I prefer the 10. I'd rather not use this on the 1, the 3. Sometimes I'll use it on the 5, but mostly the 10, 15, 30, 45, 1 hour, any mid to high time frame. Generally, it works pretty damn good. So the idea is quite simple. We're waiting for a range to form itself. I'm going to use red for my doodle. Obviously, this dark bluish color, tealish color, I should say, is the Bollinger Band high and the Bollinger Band low. This would be my structure. So pretend this is candles, this doodle here, the path tool. And we have a range itself using the Fibonacci tool, right? Just for clarification. So the idea is quite simple. Essentially, what we're waiting for is a double purge. Okay? A double purge. It's all based on momentum when you think of it. It's all based on momentum. And what I like to see to justify a range-based deviation is I want to see a deviation of the Bollinger Band twice. I want to see a deviation of the deviation while deviating. Funny, right? We want to see a deviation of a deviation. In this case here, the idea is quite simple. Before I show you guys what it actually looks like using like live examples and how effective it can be, we're going to look at the theory behind it, like the logic, how to look at it rather. In this case here, we have a swing high of the range being formed. We have our swing low. We have our confirmation, which was dead on because I drew it out this way. And then we have a purge of the Bollinger Band during the swing low's creation. So price action, or the candlesticks rather, have went below the Bollinger Band here. And we're going to pretend that we're on the 10-minute time frame. Nothing fancy. It's very basic stuff. So we had the purge, the initial purge. And you'll notice quite often when candles purge a Bollinger Band, they rotate to the other side of the band, right? Not necessarily to purge the band again, but rather to rotate to the other side of the band. Now, there will be a midpoint of your Bollinger Band. We're not too concerned about that just yet, but we will incorporate that in later in a few minutes. But for now, the idea is quite simple. So what I'm looking for is I'm waiting for price action to purge the band once again. I want to see it purge the band once again while taking out the low of the price action. Whatever the low and the high was that deviated the band in the first place. That doesn't necessarily mean it has to be a deviation of the range. It can be any point, really. It's always better to incorporate this rule within a range. But in this case here, because this low has deviated the bottom section of this Bollinger Band right here, the bottom line of the Bollinger Band, I'm waiting for both to be taken again. I want to see this exact situation where price action comes down, it takes out that low while deviating the band once again. And what I'm doing is I'm entering on the first close back within the band. Okay. Now, I've done it before where I just mark it in live time where it comes back above, but I'm telling you guys, it's better to wait for the close. Trust me on that. Unless it's a high confidence area, you have lots of support here for whatever reason. You got a big old order block that price cannot break, clear as day, genius area. It respects all your structure drawings. Well, yeah, okay, you can do that. But if it does not, then be a little bit cautious and do what I'm doing here. Now, it's always better, of course, to wait for structure to break rather than risk it for the biscuit, so to speak. But we're not doing that. We're busy. We don't have the chance to. So our entry would probably have been right around here. The stop loss would have been here, a little bit below that low. And the target is going to be the range high. Now, you can choose to target the other side of the band if you so choose. A lot of the time, it won't be like this. A lot of the time, the top of the band may be down here, right? So in that case, you get more money, obviously, targeting the range high than you would the band high. So I can always tell you guys that if I notice that price action ends up doing something like this, let's go back to the band color. Let's see if we can remove this guy, and we're going to draw that band high in again. So if I ever see an example where I seen that there was a deviation of that band high, let's use a teal color. You see how that deviated the band high? It didn't deviate the range high, but it deviated the band high. So if I see price action making its way up here, you go back to black, and I seen that it's struggling above that Bollinger Band high, then all of a sudden it cracks through, it takes out this high, and then it comes back within the band, I usually close the trade out, or at least a good portion of that trade. My stop would always be at break even in a situation like that. In fact, I opt to put my stop loss to break even as soon as we hit the midpoint of the band. You can take a partial on the midpoint of the band and put your stop to break even if you want to. By doing that, you're going to have a pretty damn good environment that you're trading in. So meaning that you're not going to be risking a whole lot. It's a high confidence way of going about this strategy. So in that case, we would put our stop loss to break even, take out half the trade here, either take the other half out here or the other half out here. Okay. Now we're going to look at a few examples of what this looks like. Put the Bollinger Band on. We'll go to the 10-minute time frame and we'll take a look. All right. So if this is a range, technically speaking, that would not have been a trade based on the Bollinger Band theory. However, it was still a range deviation. It's just unfortunate that we didn't deviate the Bollinger Band here as well, right? I would have preferred a double deviation, a purge of the purge. We don't have that situation. Maybe you still decided to risk it here. That's fine. If you did, obviously you won. But in this case, it's still not 100% the strategy. And yes, there is a big difference in terms of statistics that I ran waiting for a purge of a purge versus not doing so. So in this case, there is a chance that this may have been a purge on a lower time frame. Let's check the 5. Let's check the 3. And in fact, it was. You had a purge of the band high here. You see how price action broke above the band high, and then ultimately we came above, purging above the band high once again here? That would have been a valid trade if you were watching the 3-minute Bollinger Band. You had the range low being formed, which also purged the Bollinger Band low. You had the range high being formed ultimately, and both of them actually purged each other. So actually there was a trade here if you zoomed in, I believe. Let's take a look. Yes, there was. In fact, there was a trade right off the hop here. We missed this one. So notice how you have a purge of the Bollinger Band high, you have another purge of the Bollinger Band high, and you have a third purge. I always go with the highest one. Okay, don't say that's a trade. That doesn't count. You need to see price action pull away and then come back again. Preferably touching the orange line or the middle line of your Bollinger Band before coming back for that purge. So you have the purge of the Bollinger Band. You're waiting for the purge of the purge. Drill that in your head. The purge of the purge. So this is purge number 1. Price action came back to the orange line, came back up and took it again, purging the Bollinger Band yet again. Now we can target the bottom of the band or the low of the range. And obviously that worked beautifully. In fact, from a risk reward standpoint, if you waited for that close, the close happened right here. So you would have got in somewhere here. Your stop would have been above that high for a $20 stop loss, and you would have taken it all the way down to that low. 11.5%. Crazy, right? 11.5%. Now, obviously, if you're not incorporating it within a range using the time frames that I mentioned, there will be stop outs. Okay. In this case here, if you had to just use this little idea here, using the range within the range, you had a purge here, price action came back, and then you purged it again here, ultimately for a stop out. Why? Well, because it was actually a Wyckoff Model 1 schematic from an internal standpoint. So is it better to incorporate other things? Yes. Is it better to keep in mind that ranges tend to deviate the bigger range as well? Yes. So why wouldn't I have traded this? Oh, sorry, this guy right here. Well, I would have been thinking that this guy would have been the deviation low. I would have been thinking to myself in a live environment, if I seen this right here, I would have thought, oh, okay, so we haven't taken the original range low yet. Even though there is a miniature range here, that's kind of sketchy that we didn't take out this guy. So I don't know how I feel about trading this one just yet, right? I generally avoid ranges within ranges when doing this if they are relatively close in terms of time. So what I mean by that is this whole range here is more like a 3-5 minute range, and this is like a 1 minute range here, right? So in that case, I'd pass on this range. I'd only use the bigger one, right? I wouldn't trade the contents within it. I would trade the bigger one using the strategy. So if I had like a 1 hour range that was part of a daily range, well then yeah, we can do that. That's fine. You can trade both. But in that case, if you had a 1 hour range that was inside of a 2 hour range, nah, I think I'd wait for the 2 hour range high and low to be taken. Right? So very, very simple rules, really. Nothing too complex. Purge of the purge. That's all we're looking for, incorporating with its sideways price action. So that would have been a good trade. And then ultimately price action came back. It deviated the high and it purged the purge once again. So look, you had a purge right here in the 5. Took out that high. Use red so we can see that. And purged the band high once again. Your entry would have been right between those two candles. Your stop would have been here. Your target would have been the bottom of the band. And then down here, by the time you hit the orange line, you put your stop to break even. Take a partial if you'd like to secure a little bit of profit on the side. That's up to you. I can't force your hand. It is a smarter idea to at least take 25% out on that orange line, 25% out here, and then the rest out down here. If you're actually using ranges with this, which I highly suggest, as you can see, it makes more sense than just trusting it all over the place, you'll have a pretty damn good hit rate. Now, it's not going to be an everyday thing, per se, on the 10-minute time frame, but based on statistics, it works better on the 10. Does it mean you can't use it across various time frames? No, it doesn't mean that at all. Now, here's an example of something that I wouldn't trade. So I wouldn't say, oh, we purged here and we took that guy with another purge. I would not trade that because it didn't come back to the orange line first, right? So that's a big no-no for me. And actually, you would have been taken out of that very quickly. Right? That's why, because you didn't come back, you didn't rotate down to the bottom of the band yet. So there's a chance that it could rotate back down to those areas that it didn't mitigate before. So I'm just a little cautious with that. So yeah, you would have got absolutely destroyed in that short if you had tried it, right? So if we zoom out a little bit, we can see if there's anything else here. Let's take a look. So this might have been a lower time frame one. Let's go to about right here. Let's go down to the 3 or the 2. Okay, so this was actually a valid lower time frame one. Although it wasn't a wick per se, it was on the 5, but it wasn't really a purge of the purge in the 5. So this is where common sense has to kick in. So if I seen a situation like this and I'm like, okay, so we had a range low. I'll draw my range in very quickly. We got a range low, we got a range high. So between this point and this point, these are my range low, my range high, my range confirmation right here. Okay. And I seen that I have a purge during the range lows creation, meaning that it purged outside of the Bollinger Band. Okay, cool. And then I wait for the purge of the purge. So I wait for price action to come back to that orange line and then come down and take out that previous wick. And I want it to take out the Bollinger Band again. Did we do that? Yes, we have. Now, because it actually closed down here, that means that structure technically went bearish again, meaning that order flow expectation would be lower high, lower low. So you got to be careful with that, right? If it does close, it could very well not take you all the way up to the high again. It might stop out halfway up and just die off again. So just be careful with that. Now, going to the 5, you could argue that it barely closed below that low. Maybe on the 10, it didn't. No, it still did. So you'd be a little bit cautious with that. But technically, yes, that's still a trade. So your entry would have been obviously waiting for the reclaim, wherever the reclaim candle was in this case here, between those two candles essentially, but your stop down here, target 1, and then target 2, the range high and the Bollinger Band high essentially, which are pretty close to each other. So as you can see, it works pretty well. Now, technically speaking, this would have been a valid setup as well. This would not have been. Why wasn't this a valid setup? Because you didn't come back to the orange line. So even if you had this as a range between this low and this high, on the 2-minute time frame, this is not a trade. Price did not come back to the orange line first. Maybe on the 1, this is a trade, but it's not a trade on the 2. You have to rotate to make sure. Whereas this is a valid trade. Between this low and this high is a range. And you rotate it back up to the orange line of the Bollinger Band, which is fine. That's what we need to see. You had a purge of the band. You had a purge of the purge, taking out that low. You could have marketed in, but guess what? In this situation, you would have got stopped out more than likely. Again, it's not 100%, but it works pretty good. Ultimately, the math that I ran is that you're going to win a hell of a lot more than you're going to lose. Okay, you're going to win a hell of a lot more than you're going to lose. That's just the nature of the game here. So here's an example of another winner. So you had a range high, you had a range low. You came back to that orange line at some point in time. It hit it to the dollar multiple times here. And then you had a purge of that purge, closing back within the range, closing back within the Bollinger Band, which is key. Your entry could have been here. Your stop could have been here. Target number 1. And then you could have actually taken this guy down quite a bit lower until you had this shift in structure that existed here. And of course, obviously incorporating this with other means of TA would be wiser. Necessary? Not necessarily. Not necessarily, but wiser? Absolutely. Here's another one. You had a range high, you had a range low. You have a purge of the band, you have a purge of the purge. So entry, stop, target, success. Okay? And from there, you had another trade right off the hop. You had a trade right here. Now in this case, unfortunately, it looks like you would have been stopped out by like a fraction. Or actually, no, that's an equal low. So you would have been fine. As long as your stop went a little bit below that low, which I hope you guys have the common sense to do, you would have been fine on this trade idea. So the entry would have been here. The stop would have been under that low. And then target would have been here. You would have been fine. So, and obviously, again, this works on any time frame. It's just wiser to incorporate it on time frames that make sense. So if you're playing it on the 2-minute, don't expect a 100K move off of it, please. Play it from side to side. Don't be dumb with it. So in this case here, we have another couple of setups actually. So this was a range. You had a purge of the purge. But sometimes when the candle closes this high up, you see how that closed like halfway up the range high? You really got to ask yourself, is it worth it to enter here to put your stop here just to target here? I wouldn't have taken that one because it closed way too far back within, right? That's too far back within. It's just not worth it from a risk reward standpoint. Now, what about this guy? Yeah, I think I would have tried this guy. Why? Well, because the risk reward supports the idea. So purge, came back to the orange line, purge of the purge, and we would have entered here on any of those closes, stop right here, target number 1, stop loss to break even, target range high. So we would have hit the first target. We would not have hit the second target, which is fine. We could have been already preparing for the second trade idea. Second trade idea was this guy. So again, what do you have? Well, you have the purge of the Bollinger Band. You have the purge of the purge, taking out that low. Entry would have been right here between those two candles. Stop loss to break even on the orange line, partial 25% take profit, close the rest of the trade out right here. Bang, 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 right? This guy would have been a break even trade, plus you would have hit your 25% partial. This guy would have been a complete winner. I'm only on the 2-minute time frame here, guys. Like this is all over the place. You're always going to have these trades, always, right? They're all over the place. It's very, very fun. I like to do it myself. And it still makes sense. Why does it make sense? You got to ask yourself, why is this Phoenix guy talking about things that aren't necessarily smart money? But it is. Even though I'm using an indicator, it is. I'm using momentum in a way that I'm able to capitalize off these range-based deviation trades. And we know that range-based deviation trades are due to what? Buy stops and sell stops being triggered for a move in the opposite direction. It's all based on what? Liquidity. So of course it's smart money concepts. We're trading with institutional order flow even on lower time frames, right? That's the idea behind it. It's not that it doesn't relate to anything else at all. It certainly does. And of course, this works on all time frames. Here's the 1 hour. You'll see purges of the purge on the 1 hour. Okay, look, range high, range low. You took it. You came back above with the purge of the purge. So you purged the band once, you purged the band a second time. You could have entered right here, stop right here. Look how far that took you down, right? Purge of the purge. Down you go. Technically speaking, this was a purge of the purge. You came up to the orange line, then you would have got stopped on the remainder, which is fine, right? Purge of the purge here. You hit the orange line in between them. There you go. You had a long trade all the way up to here. This one would have gave you a almost a $3,000 move, right? So this works pretty dang good. I almost contemplated not releasing this, so you guys know that. So we had a purge of the purge here. Didn't quite hit the orange line, but it could have hit the orange line on a lower time frame. Let's go check. And this is why it's always vital to cross-reference your time frames. Look at that. On the 30-minute, it actually has. It hit the orange line on the 30, which to me would have been fine. I would have taken that because it hit the orange line on the 30. It's not a microscopic range. It's still, a $300 range. It's not like a $10 range. So it's a purge of the purge. And my entry would have been right there on that close on the 1 hour. And then I would have taken it up to the other side of the range. And then I would have let some run if I thought it had the juice to do so. Oh, look at that fair value gap. Oh, look at that fair value gap. Does it have potential to run higher? Well, yeah, right? So why not let it? So obviously the target is subjective. You don't have to take the entire trade out where I mentioned. You can take it to wherever you'd like to. Okay, purge of the purge. Hit the orange line in between. Bam, up you go, right? Purge of the purge. Orange line in between, up you go. Not quite purge of the purge, down you go, but very, very close. Let's see if it was on the 30 right here. Look at that. Purge of the purge, down you go. Blast it straight down. Purge of the purge, up you go. Purge of the purge, down you go. You guys are going to hear purge of the purge in your sleep now, aren't you? I'm sure people are laughing at that comment. So look at that. Purge of the purge, orange line, up you go. Purge of the purge, orange line, just to confirm that it even made sense. Up you go. Right? Purge of the purge, down you go. I'm sure you guys can see how effective this is. Purge of the purge. You cover this on your stop. You hit the orange line in between. Up you go. Another one, look. Purge of the purge, orange line in between. Up you go. As you can see, it's pretty damn effective. So, I mean, I love this, when I came up with it. Like, I was like, wow, did I really see this? And I thought it was the coolest thing ever. And yeah, I thought I was going to hold it dear to me, but I promised everybody I'd put it in the course, so I thought I would. Purge of the purge, orange line in between, down you go. Here's one that failed. Purge of the purge on the downside, orange line in between. You would have got stopped out. This guy overruled it. Why? Because it was a Y-cop schematic. But anyways, you make 3%, 4% on that guy. It's okay to lose 1% on this guy. You got to do the math here. Balance the scales, for God's sakes, right? Don't be silly with it. It's okay to lose a couple. You're not going to hit every single one. Look, purge of the purge, orange line, up you go. Purge of the purge, orange line, up you go. Right? Purge of the purge didn't hit the orange line, but still went down. But should I trust that? No, I would not. Right? So ultimately, you're going to see a lot of these across various time frames. Hope you guys enjoy it. Obviously, I wouldn't pick this over my other trading styles, but it's always fun to incorporate it in if you're just not sure of the current move at hand. So you can definitely incorporate it if you're just not sure of the current range deviation that you're looking at, right? Or maybe you don't have market structure to work with on any time frame. You're like, dang, I don't have any structure though. Like, it came up so aggressively. Like, if I had a range high and a range low, swing high form, swing low form, range confirmed itself. If I seen that price was coming up like this for that deviation, and I have to wait no matter whatever time frame I go to, I have to wait for this higher low to break to confirm a structure shift, and there is no structure between this circled area, then I would therefore whip out the Bollinger Band and trade it that way instead. Because if this was a purge of the purge once, purge twice, taking out the previous guy, I'd enter on the first close back within, putting my stop here, targeting this low. There you go, right?